A company that was mining Bitcoin 18 months ago is now signing billion-dollar contracts with AWS and Google. Its stock is up 563% in the last 12 months, and Wall Street's average price target implies another 45% upside from here. Ciper Digital is one of the most dramatic corporate reinventions happening in the market right now. Today, we are going to explain exactly what this company is, what it is building, and both sides of the story, because there are two very distinct sides. Ciper Digital Inc., trading under the ticker CIFR on the NASDAQ, develops and operates industrial-scale data centers for both Bitcoin mining and high-performance computing hosting in the United States. The company was formerly known as Ciper Mining Inc. and changed its name to Ciper Digital in February 2026. That name change is not cosmetic. It reflects one of the most aggressive business pivots you will see in the market today. The company's strategy is straightforward. Exit Bitcoin mining entirely and replace it with long-term hyperscale data center leases that generate stable, predictable cash flows. Ciper has already completed the sale of its non-core Bitcoin mining data centers and is monetizing its remaining Bitcoin inventory over time. The pivot is anchored by two massive campuses currently under construction. The Barber Lake data center building was topped out in April 2026, with mechanical, electrical, and networking work ongoing remaining on schedule. At Black Pearl, the retrofitting of the existing data center structure for Phase 1 is progressing, with Phase 2 site work begun in April. The current stock price sits around $20, with a market capitalization of approximately $8.5 billion and trailing 12-month revenue of $223.9 million. The reason investors are excited about Ciper Digital comes down to one thing: the contracts it has already signed. Ciper has secured $9.3 billion in contracted revenue through two landmark deals. The first is with AWS. The second is a 10-year, 300-megawatt lease with FluidStack and Google at the Barber Lake campus. Both facilities are fully funded through high-yield bond offerings completed during Q4 2025. Then in March 2026 came a third deal. Ciper executed its third data center campus lease with an investment-grade hyperscale tenant in Texas for an initial term of 15 years, with multiple extension options at the tenant's election. Together, these three agreements underpin approximately $11.4 billion of contracted revenue and roughly $787 million in average annualized net operating income. To put that in context, Ciper's entire current market cap is $8.5 billion. It has more than $11 billion in signed long-term contracts with some of the most credit-worthy companies on the planet. The forward two-year revenue CAGR consensus sits around 96%, and the forward two-year EBITDA CAGR sits around 273%. Those numbers are not built on speculation. They reflect lease revenue that is already contracted and funded. Analysts project $1.4 billion in revenue and $452 million in earnings by 2029. The bull case for Ciper Digital is essentially this: you are buying a real estate and infrastructure company disguised as a tech stock at a discount to the value of its already signed contracts. Locking in investment-grade hyperscale tenants on 10 to 15-year leases gives Ciper rare revenue visibility in what is usually a volatile space. These are not Bitcoin prices. These are contractually guaranteed cash flows from AWS and Google. On top of the leases, the $200 million revolving credit facility is currently undrawn, yanmagins, meaning Ciper has dry powder without immediately piling on more cash interest costs. That gives management optionality to fund new AI and HPC builds when the timing and pricing are right. Of the 12 analysts currently covering the stock, the average rating is strong buy, with a 12-month price target of $27.92, implying 36% upside from current levels. One analyst has a high target of $53, and the structural tailwind is powerful. Every major AI company in the world is desperately trying to secure data center capacity. Ciper is building exactly what they need in the United States with power already secured. Now the bear case, and it deserves equal attention. The first and most obvious problem: Ciper is losing a lot of money right now. The trailing 12-month net loss is $822 million on revenue of $223 million. The net profit margin is negative 367%. Operating cash flow is negative $207 million. This is a company burning cash at a significant rate while it builds. The second problem: the transition gap. Bitcoin mining still accounts for all of the current reported revenue, with HPC lease revenue not beginning until late 2026, when Barber Lake and Black Pearl come online. That means for the next several quarters, the income statement is going to look worse before it looks better. Q1 2026 revenue came in at $34.84 million, down 29% year over year, and missed analyst estimates by $2.25 million. The loss per share of $0.19 was more than 4 times worse than the $0.04 analysts expected. The third problem: the debt. The balance sheet carries $2.1 billion in net debt, the natural consequence of financing 2 300-megawatt data center campuses simultaneously. The debt-to-equity ratio stands at 663%. If construction runs over budget or over schedule, that debt becomes a serious problem. And the fourth: insider selling. Company insiders have collectively sold $82 million more than they have bought. CEO Tyler Page sold shares in March 2026, and other insiders have continued to reduce their positions. Insiders selling while the stock is rising is always worth watching closely. So what is Ciper Digital really? To own Ciper Digital today, you need to believe that its move from volatile Bitcoin mining to long-term AI data center leases with hyperscalers can eventually support a more predictable, contracted revenue base, despite current losses and high leverage. The key near-term catalyst is converting its development pipeline into contracted cash-paying capacity. The biggest risk is that high capital expenditure and operating costs keep cash burn elevated longer than expected. This is not a company you buy for next quarter's earnings. It is a company you buy or avoid, based on your conviction about what those data centers will be worth in 2027 and 2028 when the hyperscale leases begin generating full revenue. The contracts are real, the losses are real, the opportunity is real, the risk is real. Where this stock goes from here depends entirely on whether the construction stays on schedule and whether the AI infrastructure build-out continues at the pace it has maintained so far. Hit like if this helped you understand Ciper Digital, and subscribe for the next deep dive.